All right, today we are diving deep into two really powerful chart patterns that can signal some major moves in the stock market. We're talking about the classic cup with handle and its more subtle cousin, the saucer with handle. We're going to show you how to spot them, how to tell the real deals from the fakes, and, the most important part, how to actually trade them.
Yeah, what does a coffee cup have to do with the stock market? It's a fair question. But really, it's just a great visual metaphor for what a stock is doing. It's taking a little breather before a potential huge surge. Think of it like a snapshot of market psychology. It's showing a period of consolidation, a pause, before a possible breakout to new highs.
So here's the game plan for today. We'll start with the classic cup with handle. Then we'll get to know its flatter, longer cousin, the saucer. After that, we'll break down exactly what makes a pattern valid, learn how to spot the fakes, and then wrap it all up with a super practical guide on how to trade that breakout. Sound good? Let's get started.
Okay, let's start with the foundation, the OG pattern, the classic cup with handle. If you can master this one, you're well on your way to identifying all of its powerful variations.
So the most important thing to get here is that this is a continuation pattern. What does that mean? It means it usually shows up after a stock has already had a really strong run-up. It's signaling a pause, that consolidation period, before the stock hopefully continues its climb. It was made famous by the legendary investor William J. O'Neill, so yeah, it's a go-to for a lot of traders.
And here you can see it in action. This is a textbook example. See that cup, that long, rounded, U-shaped bottom? That's the stock building a whole new base of support. And then you've got the handle, that little downward drift that acts like a final shakeout, getting rid of any nervous investors right before the potential big move.
But hey, not every U-shaped dip you see is the real deal. A valid cup with handle has some very specific rules. It has to come after a 30% or more uptrend. The shape has to be a rounded U, and this is key, not a sharp V. And it usually forms over 3 to 6 months with a correction of about 12 to 33%. These rules are what filter out all the noise.
Okay, so we've got the classic cup down. Now let's look at a subtle, but honestly, an incredibly important variation, the saucer with handle. Being able to recognize this pattern can give you a huge edge because it often signals a totally different kind of strength.
So just like the name suggests, a saucer with handle is wider and it's shallower. It indicates a much longer, quieter period where big players are accumulating shares. Now why does that matter? It matters because this slow, steady buying can build a much stronger foundation for a more sustainable breakout. It's often a sign of large institutions quietly building a massive position over months.
And if we put them side by side, you can really see the key differences. The classic cup has that distinct U shape, right? But the saucer has this flatter, more gradual curve. And because the saucer is shallower, it can take way longer to form, sometimes even over a year. So definitely keep these visual cues in mind when you're scanning your charts.
All right, now that we can spot the basic shapes, let's get into the nitty-gritty. How do you know for sure that you're looking at a high probability setup, whether it's a cup or a saucer, and not some false signal? Well, it all comes down to following a very specific set of rules.
Think of this table as your cheat sheet. For both patterns, if the base drops more than 50%, that's a huge red flag. Now, the handle is absolutely critical. It must form in the upper half of the base, and it should be a quick little pullback, 1 to 4 weeks, with maybe an 8 to 12% decline. Sticking to these rules is what's going to save you from jumping into false signals.
You know, the price action is super important, but it's only half the picture. The real key to confirming a valid pattern is the volume. It is the secret ingredient that helps you tell the difference between a killer setup and a total dud.
Volume tells you the whole story of who's buying and selling. As the base is forming, you want to see volume just dry up. That signals that the selling pressure is gone. Volume should stay low during the handle, and then it needs to absolutely explode on the breakout. We're talking at least 40 to 50% above average. That's your telltale sign that the big institutions are making their move.
Knowing the ideal pattern is one thing, but spotting the fakes, that's what will protect your capital. So, building on what we just learned, let's go over the common traps you need to avoid.
This slide shows it perfectly, the difference between a real pattern and a fake out. That rounded U shape on the left, that shows an orderly, gradual transfer of shares from the weak hands to the strong hands. But that sharp V shape on the right suggests a really volatile, reactive move without a solid foundation. Those almost never lead to a sustained breakout.
And here's another huge red flag to watch for: the wedging handle. A proper, healthy handle should drift down or sideways. It's that final shakeout. If you see it drifting upward,
That's a bad sign. It means the stock hasn't properly shaken out the weak holders, which makes a potential breakout way more likely to fail.
Okay, so you now know how to identify valid patterns and how to avoid the fakes. It's time to get practical. Let's talk about how to actually turn this knowledge into a concrete trading strategy.
So why should you even bother paying attention to this pattern? Well, the history speaks for itself. In a bull market, the average gain after a successful breakout from one of these patterns is 34%. That is a powerful move that can make a huge difference in your portfolio.
And the pattern isn't just powerful, it's also incredibly reliable. In bull markets, it has a break-even failure rate of just 5%. That means 95% of the time, a valid breakout will gain at least 5%, giving you plenty of room to manage the trade for a profit. It's honestly one of the most dependable setups out there.
Here's your simple 3-step trading plan. Number 1, you enter when the price breaks above the high of the handle. 2, you confirm it with that big volume spike, at least 50% above average. And 3, and this is the most important part, manage your risk. Place a stop loss just below the low of the handle. This is what's going to protect you if the breakout fizzles out.
As the pattern expert Thomas Buchalski puts it, the cup and handle is a bullish continuation pattern that marks a consolidation period followed by a breakout. It's a simple idea, but it's an incredibly powerful concept that can help you spot these amazing trading opportunities.
So to wrap this all up, here are the key things to remember. 1, always look for that 30% or more uptrend before the pattern even starts. 2, pay really close attention to the shape. You want that rounded cup or that shallow saucer. 3, volume is your confirmation. It has to dry up in the base and then spike on the breakout. And 4, always use a stop loss to manage your risk.
The cup with handle and the saucer with handle are just two of the many patterns that can help you read the story that the market is telling. Now that you know how to spot them, what other patterns are you going to discover hiding in plain sight on your own charts?